Welcome back, everybody, to another episode of the Paper Trail Podcast. I am your host, Chris Seveney, CEO and founder of Seveney Investments. Today, we are going to talk about buying versus renting. And this is always a hot topic. And for those who are watching this video, you can see my mugshot in the corner with a graph behind me. But we'll talk about this graph and those listening and really illustrate kind of some of the points that I've always been mentioning over the past year, why I am bearish on some of the home pricing, and also what our focus and our target is in our non-performing note strategy. So let's dive in and really just start talking about this graph. And what it does is from 1970 to 2026, it talks about the cost to rent versus the cost to own. And are you better off owning a home or renting a home? And for the first decade in the 70s, it was really balanced, whereas the cost to buy and the cost for rent were very close and similar in nature. It was $225 to rent back in 1970 and $190 to buy. And I apologize, I'm laughing because you can see while going off of the gold standard has had an impact. Now, it really started to balloon in the early 1980s during the peak of home buying and the oldest of baby boomers, where the cost to own skyrocketed. And it skyrocketed not because of home prices, but back then it was interest rates. And most people don't know this. I was in probably first grade at the time. It bumped up to $875 to own a home per month versus $365 to rent. Now you're thinking that's a $500 delta, but it's really about 2.5x that value. That is humongous. It's never been higher on a percentage basis throughout time. Now, what of course happens when you hit imbalances? And this goes to my philosophies on things. Historically, over time, things always revert back to some type of norm. Now, there will be instances where there's something, an external event that happens that causes things to get out of whack significantly. We're going to talk about that. But eventually things will get back to a norm. And if they don't, we'll talk about that as well. So after interest rates peaked, they started to come down. So what happened during the 80s? Well, it dropped to homeownership. That the cost to own a home did drop, but it did not drop significantly. It dropped from $875 down to about $700 in the mid 80s, and then up through 1990, slowly got back up to about $900. So from, call it 1981 to 1990, it actually stayed pretty close because it had that roller coaster. Now, the cost of rent continued to increase. And this is one of the things that when you look at the cost of rent, rarely, if ever, does rents go down overall. And that's where we're seeing it now on some multifamily. But historically, when you look at these charts, yeah, the cost of rent and rent typically goes up with inflation. And then rarely does it go down or go down significantly, which we have started seeing that really for the first time over the last several years. Now back to the graph. So in the 80s, the cost of rent essentially went from about $365 up to $610. An 80% increase over that time, while the cost of home ownership stayed flat. So what happens if something is staying flat and something is getting back closer to it? You start to see it more in line. And then what happens? In 1998, cost to rent was more expensive than the cost to own. you started people looking at buying more homes. When people start buying more homes, values increase, so that cost and goes back. That pendulum starts to go back. I bought my first home in 2001. Actually, I was supposed to close on September 11th, believe it or not. And the seller was traveling for business that weekend, was supposed to come back to close. And of course, their flight that day was canceled. But that's how I remember first time I was going to buy my first house. But during the early 2000s, you had, the tech boost and so forth. All of a sudden, home prices started to skyrocket, while interest rates actually were starting to come down during that time. Because I remember my first loan was at 6%. And my parents are like, lock that in. You are never going to get a better loan than 6%, because they were floating around 6.5, 7, I recall. So throughout the 2000s, you had a lot of fraud going on, of course, but it was peaking towards that housing bubble. And it got to a point where in 2006, the cost to own was about $1,500 and the cost of rent was $1,000. So you started to see that $500 delta, which you saw back in 1981, 82, which was a bigger percentage, but that was a significant shift. And of course, we all know what happened in 2008, 9, 10, and the bottom dropped out. Now, interestingly enough, and this is why I tend to argue that people say we don't have enough homes in this country. During 2008, 9, and 10, there wasn't anybody who was building a home. Nobody in their right mind would build a home because it was like a falling knife. But inventory skyrocketed, and you could have your pick of homes during that period of time. And this is why I believe we typically have an inventory problem, not a number of homes problem. And it goes back to prior podcasts I've talked about where we've got millions of homes sitting vacant. We've got government agencies who lend on these loans and institutions not following through on some of these vacant properties, or going through foreclosure or getting them back on the markets. Cities, counties that take properties back at tax sales, just not doing anything with them and letting them sit on their books. The opportunity is there, but it's an inventory problem in my mind. So the sky falls and collapses, and the cost to own goes from about $1,500 back to about $850, which is pre-1981. So over 30 years, you hit that bubble in 2011. And looking back, man, oh man, people bought homes in 2011 and 12 doing very well because they got them at a very affordable time. Trust me, I know, I was part of that. But what started to happen in kind of 2012, renting was here, cost to own was here, everyone started buying again. And it made sense. People had recovered from getting the what kicked out of them from the downturn. People who lost their job got their jobs back. People who were underwater on properties finally got out from that. So people started rebuilding their lives. And for people who weren't really in the environment back then, especially the millennials right now, I'm talking about like homes and everything now, 2008 to 12 was awful. And I'm not sure we'll ever see anything like that again. Let's put it this way. I hope we don't. Okay? So took to about 2015, 2016, 17, and 18, where we hit that pendulum again. And we started to see a very balanced real estate market of cost of rent, cost to own was very much in line. And to me, when you have that balance, things are more predictable. And then, of course, COVID hit. And COVID had several factors with housing. One is it inventory extremely low, so prices skyrocketed. But what else happened? Interest rates dropped, which is kind of interesting because you think interest rates drop, the cost will go down, but the pricing increased so significantly that the cost to own skyrocketed. And then when you tack on and add things like insurance, taxes, and everything else, it just got out of control. In 2021, when the millennials entered their prime home buying age during ultra low mortgage rates, people were paying, in my mind, stupid money for property. Paying $100,000 or $200,000 over asking, and the cost to buy went from about $1,500 to $1,600 up to $2,200 in the span of a year. So it went up $600, and then it got to that $600 spread. And what happened in the 80s when you hit that, kind of flattened out while rents got up. It's bubble time, you had the bottom fall out from you. Today, it's interesting because it's something we're not seeing or have ever seen. Because the cost to buy, as interest rates have gone up, home prices are softening, but it's starting to teeter and flatline. Now the question is, over the next 2-3 years, does it go down? Does it flatten? Does it slowly just keep going up? What does that look like? Don't know. Personally, if you ask me, I think cost to buy is going to come down. Cost of rent is floating about $1,850 a month, $1,000 delta between cost of rent and cost to buy. Makes 0 sense for somebody to buy a home today. Wait, sit on the sidelines. I know people will talk about you build equity, you pay the interest, or you're paying down the principal. Yes, when they're even, that's a very valid point, or they're close. At $1,000 delta, man, save that money. That's what I would do. And people just think, oh, home prices are always going to go up, always going to go up. What's going on in Florida and Texas right now? Now, we see non-performing loans in Cape Coral and Port Charlotte that were $450,000 homes now selling for the low threes. That's a potential opportunity. At 450, it wasn't. At the threes, now it might make sense. I will mention that for people who think interest rates are going to go back down to 3 or 4%, I would not bank on that. I would buy, make sure you're going to stay there for a while, and then if rates go down and they go down significantly, then you can refinance, because the way the government does print money, which we did during COVID, house prices, the value of homes will continue to go up. Now, that's over a long period of time. Now, over short periods of time, again, it can get very rocky. As you look at this chart, to own a home goes up, down, up, down, up, down, up, up, down. Now it's skyrocketed, where the rent stays pretty stable. The interesting thing about this chart is cost of rent now has basically been flatlined the last several years, because everything in inflation has gotten so expensive, renters can't keep up. Incomes haven't kept up. Let's be honest. Look at your grocery bill. I don't care what the government tells me what the inflation rate was. I can go look at my Costco bill and tell you how much has increased, because we are creatures of habit and basically buy pretty much the same thing every single week. We're boring. So it's easy. When you're boring, it's easy to look at those numbers. Now, this is all good, great, grand. And I spent the first 15 minutes talking about where this is going. Hopefully you're still with me. How does this impact those who invest in non-performing notes? I think that's important. Extremely important. Because if you've heard me talk about this on other podcast episodes, one of the things that we shy away from is owner-occupied loans that are very recent, post-COVID. We're starting to see some finally make their way where the numbers make sense. In that previously they were 3% loans, slightly underwater, and borrowers wanted to sell them at yields that would get you 6 to 8%. Thank you, I'm good, I don't need that. But now they're not able to sell those. They've been on their books. They're not managing them. The defaults have gone on longer. And now, which previously they're like, hey, I'm going to hold this because the property value keeps slowly going up. So I still am protected. Now property values are coming down. Now they're not protected. That loan is costing them money every month. Where previously, if you have the equity and it's collecting interest, you're not losing technically because you're still going to get paid that interest. But the moment you hit that delta where property's underwater, every month that you're paying taxes, insurance, and not collecting interest, it is costing you money because your amount you're going to recover is fixed or going down. So we're starting to see those. But we've still consistently, primarily stayed away from them because the numbers don't make sense. And the borrower files bankruptcy because they want to stay in the home. It can get dragged out, but it doesn't have that equity cushion that we're looking for. If I look at our portfolio, we like to be somewhere around 40 to 50% investment to property value, meaning it's a $200,000 property, our investment, or we want to buy that note for 80 to 100,000. Now that note might have a balance of 125, 150. The investment to UPB might be slightly higher, but that is all predicated based off of specific yields we target. But that property value is really where we want to try and focus on, because for us, that's where the risk lies. And with people who bought during COVID and overpaid for these properties, it can be catastrophic. Let me share a case study. Had a property in the Smokies that we're looking at. Person bought it and paid let me step back. In 2015, when the house was built, it sold for like $500,000. 2018 sold for like $900,000. 2020, it sold for like $1.3 million. Then a year and a half later, it sold for $2 million. $2 million. And I was just like laughing because I'm like, there's just no way. I'm like, I'm sorry, it's no way. Borrower defaults on the property, goes into foreclosure. Seller wants $1.7 million, believing that the old appraisal of $2 million is still valid, which at 1.7, it would still not be a great buy. But whatever the case may be, we just had somebody I know locally say, hey, what is this property actually worth? We're just curious. We're not going to buy the note, and we weren't even going to put a bid in, or we may have, but we knew we were going to insult the person. He comes back and said, this property doesn't have a pool, and the two houses next to it were recently built, and they have indoor pools, and they're selling between 1.3 and 1.4. So this property is probably back down worth $1.1 million. So I reached out to the person. I said, hey, look, we had some people look at this, and we're viewing the property as 1.1, and I'm just letting you know, hey, you can reach out and do what you want with it, but I recommend you kind of take a look at what this value is, because that value could have a significant impact on how you want to exit this thing. And hey, look, I know we're not going to strike a deal, but I'm just telling you some of the information I'm getting, because what happens many times is people just get so caught up and want to believe the unbelievable. In this instance, Smokies, they're taking a beating. And again, the reason why this is a perfect example of that situation where people paid at that peak. And now what's happening is, in real estate, to me, is very market driven and cyclical in that market. That market is now taking a beating. And I'm not picking on the Smokies. I think it's a beautiful place, but they've had their inventory, I think, double over the last 5 years. And now they're back to numbers that are back to pre-COVID levels. So when you have twice the inventory with the same amount of people for rentals or whatever it is, what do you think is going to happen? Again, revert to that mean. So if I pull out my little fidget spinner here, I'll call it my crystal ball, and guess where these numbers are going to be headed over the next 5 years. I do think the cost to buy is going to flatline and slowly come down, hopefully not nosedive. And I think the cost of rent is going to slowly start to consider and tick up and get back to a closer equilibrium But how close? I don't know. Every time it's gotten within $500 or more, you have seen the cost to own skyrocket down. Is that what's going to happen? I don't know. But I always tell people, just be careful when the non-performing note space, when you're buying loans that are new originated, because those older loans, they have that investment to value, loan to value. Hey, look, 20% drop, which again is a significant drop, probably isn't going to have as significant as an impact, or probably would have no impact compared to property that UPB is at 80% of, and then you're paying your buy boxes at 75 or 70% of that value. So be careful. Hope you enjoyed this episode of the Paper Trail podcast. And as always, make sure to check us out online, and I will catch you on the next one. Thank you all.